In just 4 days leading up to this morning, June 26th, $200 simply vanished from the price of an ounce of gold.
Just completely wiped out.
Right. It didn't just dip. It plummeted in a way that, well, it had veteran investors and, algorithmic trading bots alike basically scrambling for the emergency brake.
Yeah, it was an absolute free fall.
Welcome to the program, everyone. I'm your host, and before we pull apart today's market madness, if you find this sort of practical, no-nonsense breakdown helpful, please make sure to like the video, subscribe to the channel, and drop a comment down below. It really helps us keep bringing you these deep dives.
It absolutely does.
Now, joining us today to decode the morning's critical precious metals data is senior market analyst Dr. Khalid Al-Nuaimi. We're looking at a massive psychological pivot point today, which is the $4,000 an ounce mark for gold.
A very, very fragile mark right now.
Yeah, fragile is the word. We've got fresh United States inflation reports. We have conflicting market signals. And our mission today is plain and simple. We are going to cut through all that noise so you know the exact forces that are moving your investments.
Right, because the sheer velocity of that drop is, it's what really demands our attention today. Whether you are actively trading these metals or, you just use them to gauge the temperature of the global economy, watching gold violently bounce off that $4,000 line tells a massive story.
A story that a lot of people were misreading, I think.
Exactly. I mean, it is a story about global inflation, monetary policy, and frankly, deep-seated fear. A vertical drop of that magnitude, it shakes the foundation of what many thought they knew about this current market cycle.
So let me set the scene for you listening. We had this absolute free fall, just a sheer drop. But then, right as gold pierced that $4,000 floor, something finally applied a tourniquet to stop the bleeding.
The PCE data.
Exactly. The May United States Personal Consumption Expenditures data. Now, I want to try to break down why this specific report matters so much because we hear about the Consumer Price Index, the CPI, all the time.
Constantly on the news.
Yeah, but my understanding is the Federal Reserve actually prefers the PCE because it tracks what people are actively buying as prices change, rather than just a fixed basket of goods. It is a more realistic look at how you and I behave when our wallets are squeezed.
That's a crucial distinction. The PCE adapts to what economists call consumer substitution.
Meaning swapping one thing for another.
Right. If beef gets too expensive and everyone switches to chicken, the PCE reflects that shift in real time.
Yeah.
And that is exactly why the central bankers watch it like hawks when they are deciding what to do with interest rates.
They want to see how the pain is actually changing behavior.
Precisely. And the entire market was holding its collective breath for this number. I mean, if it came in hot, suggesting inflation was surging, the sell-off in gold would have accelerated into a total rout.
It would have blown right past 4,000?
Oh, straight through it.
Yeah.
So let's look at the actual numbers from the reports. Month over month, PCE came in at 0.4%. And the market forecast, the expectation, was 0.5%.
Okay, so it came in slightly lower. A miss, but for a market that is absolutely terrified of inflation, a very good miss.
A vital miss. A lifeline, really.
Yeah.
Furthermore, core PCE, which strips out the wildly fluctuating prices of food and energy to find the actual underlying trend, that hit exactly on the forecast at 3.4%.
So no nasty surprises there either.
Right. But the year-over-year PCE is where the narrative gets, well, a bit complicated, and where market psychology really takes the wheel. It matched expectations at 4.1%.
Now, hold on. Let me push back on how the market interpreted that, because looking at the raw data, there is a glaring contradiction there.
I know exactly what you're going to say.
I mean, 4.1% year over year is actually up from April's 3.8%. It is the highest inflation reading we have seen this entire year.
It is indeed.
So if inflation is technically still climbing year over year, hitting a new yearly high, why on earth did the market react positively and just stop selling off gold?
Because the market wasn't pricing in the reality of the current, somewhat sticky inflation data. It was pricing in the absolute terror of a massive, unexpected runaway spike.
Oh, I see.
Right. A spike that would force the Federal Reserve to aggressively hike interest rates just to purposely stall the economy.
So the market isn't looking at that 4.1% in a vacuum. It is looking at what the number could have been.
Exactly.
It feels a bit like bracing for a Category 5 hurricane. You board up the windows, you expect total devastation, then it hits land as a Category 3.
Right, it's still a disaster, but
the relief, it is still a severe storm, your roof might still lose some shingles, but the overwhelming feeling is just pure relief that the house was not entirely flattened. The market is cheering the lack of a catastrophe, not the presence of good weather.
That is a perfect analogy. The relief rally is a powerful market force. When traders price in a worst-case scenario, and then that scenario fails to materialize, you get an immediate unwinding of those panic positions.
People buying back in.
Yes, the inline data eased the panic. And the resulting action on the charts was, well, it was immediate. We saw the panic selling halt in its tracks.
And looking at the numbers, gold instantly bounced up 0.8%, recovering about $50 to $60 to hover right around $4,040 an ounce.
A very strong rejection of the lows.
And silver, which had been just as battered, if not worse, it broke its slump and jumped 1.7%, landing between $57.50 and $58 an ounce. So the $4,000 mark for gold survived the test.
It survived, yes.
Yeah.
But we really need to follow the logic to the next step here.
Okay, let's do it.
If the PCE data was the relief the market so desperately needed, why aren't gold and silver skyrocketing back to all-time highs right this second?
That's the million-dollar question. The selling stopped, but the massive buying hasn't really started.
Right. The hurricane was downgraded. The house is still standing, so why aren't we throwing a massive party on the beach?
Exactly. Why the hesitation?
Because these metals are currently dragging two massive macroeconomic anchors. They are fighting immense gravitational pull, and, until that pull weakens fundamentally, the upward mobility is severely capped.
Let's unpack those anchors.
The first anchor is the mighty United States dollar itself.
Let's look at the nuts and bolts of that. The reports point to the DXY, which is the United States dollar index, sitting very high at 101.44.
Formidable number.
Now, for those listening who might not track the DXY daily, that is essentially a scorecard measuring the dollar's strength against a basket of major foreign currencies. It's heavily weighted against things like the euro and the Japanese yen.
Yes, very heavily.
And the sources highlight that the dollar is hitting multi-decade highs against the yen right now. But my initial thought as just a regular person is, well, if I live in the United States and I'm earning and buying in dollars, the exchange rate in Tokyo shouldn't immediately matter to my physical gold portfolio. Why is this global scorecard crushing the domestic price?
It comes down to who is actually buying gold on a global scale.
Yeah.
The international gold market is universally priced in United States dollars.
So everyone uses the dollar to buy it.
Everywhere. So when the dollar flexes its muscle and surges in value against foreign currencies, the actual intrinsic value of the gold hasn't necessarily changed, but the cost for an international buyer has absolutely skyrocketed.
Oh, I see.
It creates a global affordability crisis.
So a strong dollar literally drains the purchasing power of international investors.
Precisely. It acts as a massive dampener on international demand. So even if domestic buyers in the United States are active, the global lack of buying pressure keeps the overall asset price suppressed.
Because there's just fewer people worldwide who can afford to buy a ton of it.
Right. And until the United States dollar weakens, giving foreign buyers their purchasing power back, gold is swimming against a very strong current.
That makes perfect sense.
But that brings us to the second, and perhaps even heavier anchor dragging on the price, which is United States Treasury yields.
Yes. Let's put a pin in the dollar and look at those yields. The reports show the 10-year Treasury yield is hovering around a high of 4.39% right now.
Very high, historically speaking.
And I look at that and think about the fundamental nature of gold. Because at the end of the day, gold is a rock. A highly prized rock, obviously, but a rock nonetheless.
It doesn't do much on its own.
Exactly. It doesn't pay a quarterly dividend. It doesn't generate monthly interest. You buy it, you put it in a safe or a vault, and you just hope it appreciates because it is scarce.
And that lack of yield is gold's Achilles heel in a high interest rate environment. We have to look at the fundamental economic principle of opportunity cost.
Right. What you miss out on by making a choice.
Exactly. Imagine you manage a massive institutional pension fund. You have billions of dollars that need to generate a safe, reliable return to pay retirees.
Okay.
You look at gold, which pays nothing while it sits there, and then you look at the United States government stepping up and offering a virtually risk-free bond, paying almost 4.4% guaranteed. The math becomes very, very simple for institutional capital.
The big money just takes the guaranteed check.
Always. Every single time. High yields make non-yielding assets incredibly unattractive to hold in massive quantities.
So they dump the gold and buy the bonds.
Or they just don't buy the gold to begin with.
Yeah.
Huge amounts of capital that might otherwise flow into the gold market to push the price up are currently being vacuumed into the government bond market instead.
Okay, so we have the strong dollar killing international demand and high bond yields killing institutional demand.
Those are the heavyweights.
Those are the two massive headwinds holding the price down today. But digging into the sources, they highlight a hidden macroeconomic factor quietly working in the background, something that is actually working in gold's favor over the longer term.
A quiet catalyst, yes.
And that factor is dropping oil prices.
This is where we need to look past the daily, hourly charts and see the structural shifts happening beneath the surface of the global economy.
The bigger picture.
Right. Oil has recently stabilized after a sharp drop. The data shows West Texas Intermediate crude, which is the United States benchmark, sitting around $72.15 a barrel.
And the international one.
Brent crude, the international benchmark, is at $75.80.
So oil is getting cheaper. But map out the physical chain reaction for me. How does a barrel of crude oil getting cheaper dictate what my precious metals are going to be worth, say, 6 months from now?
Well, think about the physical, tangible economy. Lower oil prices directly and immediately translate to lower transportation costs and lower manufacturing costs across the board.
Because everything moves on trucks and ships.
Everything. It gets cheaper to synthesize plastics, it gets cheaper to run massive agricultural equipment, cheaper to load container ships and move goods across the ocean.
Which naturally drags down the overall cost of goods on the store shelves.
Exactly.
That's like oil isn't a thermostat, oil is the actual fuel burning inside the economy's inflation engine. If the price of that fuel drops, the engine naturally runs a little cooler.
That is exactly how the physical economy translates to monetary policy. If inflation authentically cools down because the underlying energy and transportation costs are cheap, the Federal Reserve finally gets the concrete economic data it needs to loosen monetary policy.
To finally pivot.
Right. They can take their foot off the brakes and start actively lowering interest rates.
And if we tie that back to what you just explained about opportunity cost, if interest rates drop, those high bond yields drop.
They fall right alongside them.
Suddenly, that risk-free 4.4% isn't on the table anymore.
And that is the exact moment the big institutional capital rotates out of the bond market and floods back into the gold market.
Oh, wow.
They come looking for returns, and that sudden influx of capital shoots the price of gold up. Cheaper oil today lays the groundwork for higher gold prices tomorrow.
It is a fascinating domino effect. Really shows how interconnected it all is. But I want to bring all this macro theory back to the immediate, messy reality of the price charts today.
Let's get into the charts.
The market has transitioned from outright panic selling to cautious observation. And that transition has turned the $4,000 mark into an absolute psychological war zone.
A war zone is the perfect description. In the short-term outlook detailed in the reports, gold actually pierced this floor. It touched $3,965 an ounce.
That's significantly under the line.
It is. The sources note that as a 7-month low. But the second it dropped that low, buyers rushed in with incredible volume to defend it. They drew a literal line in the sand.
I want to get into the actual mechanics of how a floor like that holds. Why is a round number like 4,000 such a battlefield? Are there just thousands of traders sitting at their desks simultaneously refusing to click sell below that line?
Well, human psychology plays a significant part, certainly. We naturally assign value to whole, round numbers. It feels significant.
Right.
But the real battlefield is run by algorithms. Modern institutional trading is heavily automated.
It's all bots.
Mostly, yes. These algorithmic trading bots are programmed to execute massive trades based on specific mathematical parameters, and they cluster around these major psychological milestones.
So they're waiting for it.
Yes. When the price approaches a massive round number, like 4,000, you have millions of automated limit orders programmed to instantly buy, defending that floor automatically without human intervention.
And if the price convincingly breaks below that floor, what happens to the algorithms then?
Then you trigger what's called a stop-loss cascade.
That sounds bad.
It is violent. The bots are programmed to automatically sell to prevent further losses once a key support level fails. If that $4,000 floor truly breaks, the automated selling takes over and the drop resumes with a vengeance.
So where are we right now?
The technical analysis tells us the support floor to watch right now is a very tight, fragile band between $3,970 and $4,000. If it holds, resistance sits just above at $4,045 to $4,080.
So it's trapped.
The price is entirely boxed in by these automated parameters.
And silver is mirroring this struggle, just with a lot more volatility and speculative pressure, right? The sources show it oscillating wildly between $57 and $59.
Silver always amplifies gold's movements. It's much more reactive. But the volatility around these technical lines raises a very important point for you, the listener, regarding the long-term outlook.
Okay, what's the long-term view?
Well, despite this short-term bloodbath and the fact that we are hovering over a potential algorithmic trapdoor at $4,000, the long-term bullish foundations for precious metals haven't actually changed at all.
Right, the macroeconomic supports are still massive. The sources point out that we still have unprecedented central bank buying. Nations are continuously hoarding gold by the ton, month after month.
We have to ask why they are doing that.
Right.
It is because we are looking at record-high global public debt across the developed world. Furthermore, recent geopolitical events have shown nations that holding foreign exchange reserves in United States dollars carries a massive risk.
Because of sanctions.
Exactly. Those reserves can be frozen or sanctioned overnight. There is a palpable growing desire among various nations to de-dollarize their reserves.
To hold something nobody else can switch off.
Right. The structural, foundational demand that drove gold to these heights over the past few years is absolutely still intact.
So what did this all mean for you listening right now? Let's transition from the theory to actual practical application.
The strategies.
Yeah, what should you actually do with this information based on the sources? Let's say you are a current holder. You bought in at a higher price, and you just watched $200 evaporate from the price of your asset over 4 days.
The primary warning across all the analysis we reviewed is crystal clear. Do not panic sell.
Just hold the line.
If you are holding physical metal or standard non-leveraged positions, the sources suggest treating this as a long-term accumulation asset. Selling at the bottom of a panic cycle is how you permanently lock in losses that were previously just numbers on a screen.
Right, you make the paper loss real. But what if you were sitting on new capital? You see gold bounced off 4,000, you see the bleeding stopped, and you want to jump in right now to catch the rebound.
The warning there is just as stark. Do not suffer from the fear of missing out. FOMO is dangerous here.
Why is that?
Do not buy heavily into sudden short-lived spikes just because you saw a green candle on the morning chart. The market is highly reactive and still trying to find its footing. It could easily test that floor again.
The recommended strategy highlighted in the sources to manage that risk is dollar cost averaging, basically breaking your capital into smaller chunks.
A very prudent approach.
You buy in slowly at these lower levels over a set schedule, rather than pushing all your chips to the center of the table at once. I like this approach because of the sheer mechanics of it.
It takes the guesswork out.
Exactly. When the price is high, your fixed dollar amount buys fewer ounces. When the price drops, your fixed dollar amount automatically buys more ounces, naturally lowering your average cost over time without you needing to time the market perfectly.
It smooths out the volatility, completely removing the emotion from the equation. And speaking of volatility, that leads to the most crucial warning we need to emphasize today.
Yeah, we need to hammer this home.
Both of us need to make this crystal clear based on the reports. Do not use high leverage right now. I'm going to pull a direct quote from the analysis we reviewed.
Go ahead.
The sources state, any highly leveraged position in this transition zone is playing Russian roulette with algorithmic volatility.
Man, Russian roulette.
That is incredibly strong language for a dry market analysis report.
Because the market is just too sensitive to incoming data right now.
Exactly. Right now, macroeconomic news will override technical chart patterns completely. We have upcoming gross domestic product data. We have jobless claims, speeches from Federal Reserve officials.
A minefield of data points.
Any single one of those data points could cause a $50 swing in a matter of minutes. If you are highly leveraged, a technical glitch through that $4,000 line could trigger a margin call and wipe out your entire account before the market even has time to realize the initial data was flawed.
You are basically flying a small plane through a thunderstorm. This is not the time to be doing acrobatics with margin debt. Survival and capital preservation are the priorities in a volatile transition period like this.
Capital preservation must be the priority until the macroeconomic headwinds actually clear.
All right, let's wrap this all up into a neat, practical package. Gold and silver just survived a major scare. They successfully defended the $4,000 and $57 lines, largely thanks to United States inflation data that was, well, not terrible.
This is passable.
Right. The hurricane downgraded from a Category 5 to a Category 3, and the market breathed a huge sigh of relief.
But the exceedingly strong United States dollar and those high Treasury bond yields mean we are firmly in a holding pattern. We are not at the start of a brand new aggressive bull run just yet.
It is a precarious holding pattern, which brings up something I think is really worth reflecting on as we close out. A thought that builds on that long-term outlook we discussed regarding the central banks.
It's a fascinating paradox.
It really is. We noted that these global banks are the ones providing a massive long-term floor for gold prices by constantly buying it up. They are hoarding it to hedge against massive public debt and geopolitical risk.
It is the ultimate contradiction in modern finance.
How so?
Well, if the very institutions that control the fiat money supply, the money backed simply by government decree rather than a physical commodity, if those central banks, the ones who set the interest rates and literally print the currency, are quietly hoarding the ultimate non-fiat asset.
Yeah.
What does that tell you about their true confidence in the global financial system they themselves manage?
Man, if the architects of the house are sleeping in the bunker out back, maybe the rest of us should pay very close attention to the weather report.
A very apt way to put it.
That is definitely something to chew on. The market managed to pull the emergency brake at $4,000, but keep your eyes wide open because we are definitely not out of the woods yet. Thank you for joining us on this deep dive. If you found value in this breakdown, please hit that like button, subscribe to the channel, and leave a comment with your thoughts on where the market goes next. Keep questioning the headlines, stay grounded, and we will catch you on the next one.